Hey everyone, welcome back to the channel. If you're new here, I'm your host, and today we're diving into a hot topic that's got everyone in the precious metals space buzzing. Gold price falls after strong US jobs report. Buying opportunity or trap in February 2026? As of right now, on February 12, 2026, gold is showing some real volatility. And if you're like many of my viewers here in Pakistan, where gold isn't just an investment, but a cultural staple for weddings, savings, and hedging against rupee fluctuations, this could hit close to home. Mohammed, if you're watching from Islamabad, this one's for you. Let's break it down step by step with fresh data straight from the markets. First off, let's recap what happened today. Gold, trading under the ticker XAUUSD, opened the day around $5,070 per troy ounce, but quickly faced selling pressure. By mid-session, it had dipped to as low as $5,040, marking a decline of about 0.88% from yesterday's close. Now, that's not a massive crash. We're talking a modest pullback, but it's enough to shake out some weaker hands. Remember, just last month, gold hit all-time highs near $5,608. So, this drop trimmed some of the gains from the previous session, where we saw a 1% advance. Overall, gold is still up an impressive 9.91% over the past month, and a whopping 71.96% year over year. That's huge, especially when you consider how it's outperforming many stocks and even crypto in this uncertain economy. But why the fall today? The big culprit is the stronger than expected US jobs report. Let's unpack that simply. The January nonfarm payrolls data came in hot, 130,000 jobs added, way above the previous month's 48,000. The unemployment rate also ticked down unexpectedly, signaling that the U.S. labor market is more resilient than analysts thought. Here's a quick visual on that. Check out this chart showing the monthly changes in U.S. non-farm payrolls from last year into 2026. VerifiedInvesting.com, U.S. non-farm payrolls report for January 2026, monthly jobs data and market outlook. You can see those green bars spiking up in January, a clear sign of strength. This data basically poured cold water on hopes for quick Federal Reserve rate cuts. Markets had been pricing in a cut as early as June, but now bets are shifting to July or later. Why does that matter for gold? Gold thrives in low interest rate environments because it doesn't yield interest like bonds or savings accounts. When rates stay high or cuts get delayed, the US dollar strengthens, and a stronger dollar makes gold more expensive for international buyers, putting downward pressure on prices. For my Pakistani audience, think about it this way. With the rupee already under pressure from inflation and global trade imbalances, a stronger USD means importing gold gets costlier. But on the flip side, gold's role as a hedge against currency depreciation remains strong. We've seen this play out before. During past Fed tightening cycles, gold dips temporarily, but rebounds on safe haven demand. Now, let's shift to the technical side. If you're a chart watcher like me, today's action is fascinating. Gold has been consolidating above the key psychological support at $5,000. Take a look at this daily candlestick chart for gold as of February 12, 2026. FXleaders.com Gold Price Analysis. XAUUSD stabilizes above $5,000 as trendline support holds. Forex News by FX Leaders. You see that red candle today, but notice how it's bouncing off the trendline support around $4,940, which aligns with the 20-day moving average. Immediate resistance is at $5,100 to $5,170. If we break above $5,170, bulls could target $5,300 pretty quickly. On the downside, a drop below $5,000 might test $4,795 or even $4,703. But that's looking less likely given the rebound we've seen. Gold's recouped about half its losses from that historic 13% rout earlier this month. Here's another angle. This support and resistance chart highlights the key levels. Kitco.com, support/resistance levels emerge as gold rebounds. Kitco News. See those Fibonacci retracements? The 38.2% level is holding firm, suggesting this pullback might be a healthy correction in a longer-term uptrend. Volatility is still high, but the RSI isn't oversold yet, so there's room for more downside if tomorrow's data disappoints. Okay, so that's the bearish case from the jobs report. But is this really a trap or a golden buying opportunity? Let's talk counterforces that could flip the script. First, geopolitics. Tensions in the Middle East, especially US-Iran relations, are keeping safe haven demand alive. Gold loves uncertainty. Wars, elections, trade spats, and with the US election cycle heating up, expect more inflows. Second, central banks are on a buying spree. The People's Bank of China just extended its accumulation streak, and even states like Texas are pushing gold-backed initiatives. This structural demand is huge. Analysts say it'll provide a steady bid through 2026. Third, the long-term outlook is bullish. Despite today's dip, gold's up over 70% year over year because of de-dollarization trends and fears of sovereign debt crises. For Pakistanis, this resonates. With our economy tied to remittances and exports, gold acts as a buffer against global shocks. If the Fed does cut rates later this year, markets expect at least 2, real yields drop, making gold more attractive. Plus, physical premiums are elevated, showing strong underlying demand even as paper prices wobble. Now, what could happen next? All eyes are on tomorrow's US CPI data. If inflation comes in softer than expected, rate cut bets could reignite, pushing gold toward $5,200 or even $5,280 as per some forecasts. On the flip side, hot CPI could extend the pullback to $4,900 support. Longer term, analysts are optimistic. Trading Economics sees gold at $5,021 by quarter end and $5,347 in 12 months. Some, like Wells Fargo, predict $6,100, $6,300, and in a super bullish scenario, up to $7,300 based on Fibonacci extensions. But watch for risks. A stronger dollar or industrial slowdown could cap gains. Speaking of related markets, let's touch on silver, as many of you ask about it in the comments. Silver is often called gold's little brother, and today it followed suit, falling 1.70% to around $82.86 per ounce. The gold-silver ratio widened to 61.2 to 1, showing silver's underperforming tactically. But fundamentals are solid. The Silver Institute forecasts a 6th straight supply deficit in 2026, driven by industrial demand in solar and electronics, even as jewelry use dips. Check this silver forecast chart. Dukascopy.com silver price prediction, chart and price forecast for 2025-2026, Dukascopy Bank SA. Support at $80, the 50-day EMA. If it holds, silver could rally to $84, then $86.50. Long-term, expect upside to $91 or more, but near-term, it might lag gold if rate cuts delay. For direction, bullish if CPI softens, but watch for a dip below $81.85 Fibonacci level as a warning. Wrapping up, is this gold dip a buying opportunity or a trap? In my view, it's more opportunity than trap. The jobs data caused the knee-jerk reaction, but underlying supports like central bank buying and geopolitics are too strong to ignore. If you're in Pakistan, consider accumulating on dips, physical gold via trusted dealers or ETFs, but always diversify and don't go all in. What do you think? Buy, hold, or sell? Drop your thoughts in the comments, like if this helped, and subscribe for more updates. Thanks for watching. See you tomorrow after CPI. Peace out.